Tom, I'm going to make you the presenter now. So I look forward to hearing your voice and seeing your screen. Thanks for waiting. We had a lot of stuff to cover today. Appreciate it, my trading warrior brother. So Tom, looking forward to hearing your voice. Tom Malone, Twitter handle at Tom and Krishna. Runs a room. Was fortunate enough to work with Dr. Martin Zweig, who's famous for his expression, "Don't fight the Fed." So just waiting for you, Tom. I see your screen. Waiting to hear your voice.
There, I'm unmuted now.
Okay, great. Tom, so nice to meet you.
Great to meet you. You guys do a wonderful job. Boy, I spent the last half an hour looking at more charts and seeing more new information than I have in the last month. So I appreciate you guys being here.
Oh, well, thank you very much. We're pretty proud of the team. You know, we brought in, it's unusual, we brought in experts with different disciplines, you know, Elliott harmonics, candlesticks, and, you know, that way people in one place, instead of subscribing to different types of methods, can get it all in one place. So, you know, how fortunate were you to work for Dr. Martin Zweig? I usually start by asking people what their journey was like at the beginning of their career. So was that your first job in the industry, working with Martin Zweig?
Actually, no, but it was actually the highlight. It was a menial job at the time, but as you know, time flies. That sounds like we're probably about of the same generation. Don't know for sure, Dale, what year you were born, nor would I ask. But
oh, it's okay. 1953, and yeah, so. Menial jobs, yes, Tom. I started as a runner on the floor of the CME. So
yeah,
you know, you have to start somewhere, but why not start in an environment where you're going to gain all kinds of knowledge that will more than compensate you in your future, even though short term. It's like the markets. You know, you don't always get immediate gratification on a trade. Sometimes you have to sit through a drawdown before it manifests. So. What was it like working for Marty? And he is the guy that's famous for saying, "Don't fight the Fed," right?
Right, and what an apropos last decade, as the Fed has taken on new meaning, hasn't it, worldwide?
I wouldn't have believed that it would that we'd have this outcome last as long as it has.
Yeah, it seems like it caught on in the Bernanke era, and now the world has micromanaged this, so it's almost like it's preventing any type of pullbacks worldwide. And again, whether it will continue to be this way for years to come, or whether I always give my members and people that will listen to me long enough the example. I grew up in Clinton, Iowa on the Mississippi River. And as you know, they put in a whole system of lock-in dams from Minneapolis down to New Orleans. Right. But occasionally, those dams have gotten run over, and I think the markets are like that. The Fed can put up all kinds of artificial places, but when Mother Nature is going to work in the fear and greed process, it's going to work. I always like to.
And the Mississippi changes direction sometimes, doesn't it?
Absolutely. There's times when Mother Nature plays some little tricks, but it was interesting life. Again, looking back, my first real job was we had a place right on the river that shipped out corn. Okay. It's now an ADM plant, but I got to see firsthand what trading corn futures was like when I was a sophomore in high school.
Wow. Yeah. I went to college in DeKalb. That's corn country.
Oh, so, my goodness.
Yes. Go ahead.
Yeah, I was going to say, there's several universities around DeKalb and up there Bloomington, and that is great.
I didn't even have an inkling I'd end up trading it when I was there. But interesting. So what did you do when you were with Dr. Zweig?
My first job with Dr. Zweig was kind of like you, was just to be an extra person. He was just starting out his famous Zweig forecast. We had met, he was a little bit older than what I was, but not too much. I was a non-traditional student at the time, going back to get another degree, always looking for education even back in the day. And we met through different channels, and before I know it, he had started up, had been very successful with the Zweig forecast, and then he was just started. He needed more people to stuff envelopes, believe it or not, for his Zweig's ratings forecast, which was the second actual where he just started using, believe it or not, as he was a groundbreaker, started using computers to rate, kind of like Value Line does, and some of the other ones, rate them on a 1 to 10 basis on timeliness and value and things like that. So I was a envelope stuffer, and had my ear wide open as I was an active trader also at the time.
Okay, so you're a Fed watcher, Tom.
Oh yeah.
Mari said don't fight them. You know, every time it looks like the market might be due for a correction, even though the Fed has tightened, what, 3 times now? You know, that old Wall Street saying 3 hikes and a stumble. Hasn't happened.
3 steps and a stumble, correct.
3 steps, so 3 steps and a stumble. I've stumbled on less than 3 steps, but where's your head at with what's happening in the Fed? And I notice in your tweet that you sound like you have a lot of conviction about some turning points in the market, and be interested in seeing some of your charts and what's on your radar.
Right. I don't have much in the way of charts. Hopefully I can borrow some of yours, but the big key I want to throw out there is, again, that not only the Fed used to be back in the day, and when we had been going through the business and really got involved, the Fed was very, very non-transparent, and would do things sometimes in the dark of night. And as you know, Greenspan would talk in all kinds of gibberish, and during
people
that
tried to figure out what he was going to do by whether or not his briefcase looked full or not. and you probably even remember the days when the money supply releases on Friday were big market movers.
Exactly. People would wait for that and not take off for the weekend yet. But again, this is the world has gotten smaller, and Federal Reserve and central banks have united together since 2007, 2008, 2009, and really have put a protective put underneath the market by adding liquidity at every single correction, every single pullback, and any sign of trouble. It's almost, I call it to my members and my subscribers, that it's almost a national defense system, because they want to protect their economy against foreign adversaries and things like that. So it has.
So do you believe there is a plunge protection team?
Oh, absolutely, and I think not just in the United States, but it's a global synchronized type thing, and that's why I said the biggest theme that we have right now today at the second is a global synchronized rally, and it's all from the bottoms in both the United States, Europe, and China's in some type of a bubble right now, but that's something for probably a whole day subject. But the fact is that we've got so much protection while VIX is at nothing, and there's no movement, more or less, in our trades. And again, there's no doubt in my mind over the last 9 years that the central banks and all kinds of protection has been put in place so as to not have another depressive-like period.
Okay, so we can never really have a bear market again.
And that's what they want you to believe, and that's what they want the public to believe. I think they want the.
How about what you believe?
Well, I believe that we're going to have an amazing another depression, probably, sometime by 2020. Again, it's within probably 36 months at the most, and 6 months at the least. I think, like I say, the old nature will rule type of thing. We will have another recession, and we will probably have a huge scare. We've got you can't take away
what's gonna pop the bubble. Could it be like, I've talked to Martin Armstrong, and let's face it, cheap rates have buoyed everything, real estate, equities, etc.
Correct.
So could it be the bond vigilantes starting in Europe with the way the Bund looks now and the dollar being under pressure, that it could be a bear market in bonds? I mean, bonds look like they're, they peaked. We tried to recover in the bond market over the last several months, and now it looks like they could be headed again down to new lows or break through that 265 10-year level.
Right.
Do you think that rates are going to be the pin that pops the bubble?
I think it's actually going to be the other way around, to be quite honest.
Really?
I think
it's too strong of a dollar.
I think it'll be a recession. I think that we can't agree on anything, so it'll be a budget deficit, debt ceiling not met, a downgrade of USA again. It'll be something along that line that will be more depressive than stimulative. Everybody thinks, and my last 11 years I've done 90% of my really hard research in sentiment, and the fact is everybody thinks that this bull market will end with 5% GDP and everything running hot and all this stuff, and I think it'll be the opposite. I think it'll be the plain old end of an economic cycle. You look at four major reasons why markets end up turning negative and going into a bear market, and you look at the things that out there that could cause a global unrest. Again, too protective of a Fed, and none of those things right now. We are dying to get some inflation going, but we can't. As you know, Japan has been pushing. They'll never reach their targets. We'll probably never reach our targets. My biggest fear for the next real break in markets and in financials is recession. And I think it could come as soon as late 2019. And it will be on the back of some things that we probably don't even know that will happen. A lot of things we know, like student loans and subprime autos, and the Canadian banks had a real tough time, and they just hiked rates to help them out a little bit. There's things out there that they're around, but you don't really talk about much. But I think that's the way it will end, is not in the grand 99 type scheme where everything is just going up every day and the economy's hitting on all cylinders like it is now. Global synchronized rally from, as I tell my members, from Shanghai to Vietnam to New York and San Francisco. I mean, this is one of the best weeks, if you believe it or not, of this bull market. If you look at the EDC, which is the 3 times long world index, the EDC has had like a 20% up week, and these are, this is a simple ETF that gets a ton of volume. The world index has skyrocketed this week, had one of the best weeks since 2011. So it's buoyed worldwide, and now we're getting dragged along. I think we're 23rd, Dale. I think
we're way underperforming. Is that because of the dollar weakness that we've seen, emerging market currencies?
Dollar weakness, and as you know, after Donald Trump was elected, we boomed and kind of led, and since we haven't been able to accomplish anything at the White House, some of that has slowed down, while the rest of the world has just really banged up. I mean, I think we're 23rd in the list of gainers for the year. We're doing pretty good today, obviously, and setting new records today and trying to catch up. But I've always said in 2017 that we'll be dragged along by the rest of the world, and that's exactly what's happening so far. As the rest of the world is just dragging us while we're up about 10%. The rest of the world is, 20 to 30% up.
Which just really began this year. It's
Yes,
been the other way around for a long time.
absolutely.
Is it possible that when the world markets or emerging or anywhere outside, I know a lot of people, like I interviewed Mark Yusko, he really likes, emerging markets because there's value there, that when they have hiccups, that because we're a laggard in relative strength, that our pullbacks will be deeper now instead of shallower?
And those are two things that should happen. Volatility obviously should go up, and our pullback should be deeper, because just in the last couple of weeks you see that a lot of money is pulled out of the United States. Even though we're at record highs, you'd think that more money would be pulling in. That's the thing that's happened over the last 50 years. But now money's pulling out of USA, and obviously, since emerging markets are going up in the statistics that we follow, the money's going straight into Asia and into Europe. The Jamie Dimons of the world just absolutely say that they can't believe the turnarounds in Europe and the progress that they're making. And the money goes, fast money at least, goes to where it gets treated really well. And right now, it seems like Europe, Asia, there's different parts of Asia can't believe that, that's one thing about sentiment is who would think that South Korea would be up, 3 times as much as we are this year, with all the problems with the intercontinental ballistic.
I got an interesting question from Luca. He's going, hi, Tom, talking about the Fed. What impact do you think make Cohn the nomination for the Fed, reversing Yellen's policies of hikes and weaker dollar in line with Trump's wishes? So she's up for renomination. She said she'd consider it, I think, sometime near the end of the year. You think that's a possibility, that Yellen's reign ends under Trump?
Oh, absolutely. She's out and Cohn's in, and the fact is that just can't be more psychologically bullish for the people that are betting on this market long right now, just today and since the election. The fact is that lower regulations, lower taxes, all the things that are in the platform are uber bullish, and you just can't stop it. I spent 6.5 hours yesterday getting my people longer and longer and longer, and say you just cannot stop this. The fact is, when you get at this stage of the market, when you're in a very late stage bull market, and the Fed just put us into, I think the NASDAQ got down 6%. That's our biggest correction of the year at the worst. The futures did. And there goes the Fed, just turn on a dime from pretty hawkish to right back to uber dovish, and here goes the market just straight up, back up into new highs. And I think that will continue. Like I said before, most people are thinking that the way this ends, and you see the Dalios and the Teppers and things like that, think that it'll get so hot that we'll raise rates a bunch of times and everything. I think it'll be the exact opposite. I don't think we can get out of the way of ourselves, and much like Japan, demographically, we can't grow at 3%. You heard Janet Yellen talk just yesterday, the fact that she would be surprised that in her lifetime if we could grow at 3%, and that's pretty embarrassing, really. So that means any type of crisis that would come up if we do, like I said, the number one concern is global problems with political and war. Any type of war, any type of conflict, again, you don't have much to work with when you're only growing at 1.5%. And
isn't that why the Fed has been raising rates anyway, to prepare to have some tools just in case?
Absolutely, 100% correct, Dale. I don't think they would. I believe that they would have stayed steady at zero if they could have. But again, they have to have something to deal with down the line. And like you say, we call it the plunge protection team, or we call it the global world order, whatever you want to call it. It's out there and it's there to protect. And you know, we probably should be thankful for it. We shouldn't look at it, but as market purists, I think a lot of us are, you know, we really think that we should be off training wheels right now. We should let all the world economies do what they can. I think that makes for a stronger world, and it makes for better entrepreneurialism, and also gives us a little volatility to trade.
Okay, so I'm assuming bullish S&Ps, nothing can stop it. Any upside targets that you have technically? On some of the super bulls I've talked to, like Peter, what was his name? Not Peter Temple, he's a long-term bear. Peter Goodburn, Elliotician, thinking 2,700 by the end of the year, and then a 30% pullback to 21, but then eventually 4,200 S&Ps.
Really?
So
yeah.
That's big picture stuff.
Yeah, big picture. If I had a big picture, I'd be along kind of that line. But again, once we have that first really big correction, which I think will probably have to happen by, you know, November at the latest. Again, I think we can easily go to 2,700 in between now and November if the current regime stays in place, meaning that nothing happens news-wise. We can go to 2,700 pretty easy. There's no doubt about that. But the fact is, if we do get a break, say before November, say if we have our typical, you know, August, September, October type of splash 5% or so, I think that it could go a lot deeper, just because we are so, you know, just basically fundamentally overvalued. Our country, the United States of America, lower dollars helping us out on corporate profits. But again, you can see from, you know, just the things that have happened this week, stupid things like, you know, F.A.C.E reports beats on both sides, and it's a very heavy cyclical, and it goes down big. J.P. Morgan, you know, beats on both sides today. They go down. The expectations on everything are at absolutely perfect levels right now.
Right. So interesting you bring up that fall time frame. I want to ask you, you watch a lot of markets, and you know there's been a lot of discussion about market structure, Tom, and in the precious metals we've had these like 30-second 1-minute flash crashes where they just go and clean out every stop,
right?
And kind of had that in Amazon one day, that, you know, when you and I were new in the business, we had open outcry. There were humans involved in this,
right? Always something.
Could market structure be the reason that we could go deeper than what we would normally do, because the machines are running the markets and bids just disappear for a period of time?
Right. And that's why, you know, especially in the Forex business, I mean, it just amazes me every day when I watch the Forex that again there's not more risk of, you know, these fat finger trades and these mistakes that turn into something deeper. I think that you know, with the election stuff that we went through, with the hacking that's out there and everything else like that, you know, the cyber crime, so to speak, of the next decade will be in, you know, some of the Forex areas and the currency areas that are so easily, I think, attacked, and that's a scary thing to look forward to, is the fact that these defenses aren't strong enough yet. We saw an election, you know, both in France and here, that was pretty much disrupted by cyber attacks. There's no reason to think that again, the attacks won't get geared more towards our financial systems, and that's a scary thought going forward, because we've seen, you know, I still have clients and subscribers from back in 2007, 2008, 2009 that lost all their money on simple things like money market funds, again, that went broke. Again, people have almost forgotten about things like that. And I think once they get reminded, because we have been nailed in our lifetime anyway with 87 and 99 and 2007, those were all things that stick in the back of your mind.
Yeah. I was going to ask you, since I see you were in the room and you were talking about gold, I thought we might switch gears again here. And you said
Sure.
your largest positions here. I put the gold chart up for you. Tell us what you're looking for in this instrument.
Well, gold again.
And I know you buy the shares too, so go ahead.
Right. We do our favorite positions again in gold are leverage. We really like extremes, and as you can tell from the chart earlier this year, back at our Christmas break, we got long of gold just on a sentiment buy signal. We really like to deal with extremes because we feel like as leverage.
Did you learn that, Tom? I gotta call you on this. Did you learn that from Dennis Gartman of gold? Well, okay, you know what I'm talking about, don't you, buddy? I mean, he's the only one I ever heard. He goes, well, I'm long of this against this. I'm short of this. Did you learn that from Dennis Gartman?
No, but I never ever trade anything against anything else. Really, I'm like Marty Zweig. I was brought up with the fact that you make your trade and you stick with it. You put your stops in and you let it run. Jesse Livermore type stuff. Again, I'm not much on pairs trade. That's why I said with hedges, I like to use straight out. Futures if I want to hedge myself. But in like a position like gold, I just feel like gold over the next year will ultimately outperform a lot of other assets just due to where we are sentiment-wise. Like I mentioned back at Christmas break of 2016, we had gotten extremely
down here. Great buy.
Yeah, great buy. It was it actually fell right into Christmas, and we actually had a little correction. Actually, one of the last corrections we've really had for the S&Ps right at the towards the end of the year. And again, it's really interesting that the sentiment in gold, as you know, gold bugs, they're really an emotional trade. Out of all the things that we trade, I don't know what you think, Dale, but I think gold and precious metals is probably the most emotional trade there is out there. People really get, this is my gold, this is my silver, this is mine. So the sentiment portion of gold, I really do a lot of really hard work on. And to be quite honest, one of my greatest lines and that I borrowed again from Dr. Zweig is, gold and precious metals always end up in tears. And I'm sure you've heard that before because gold has broken more people's hearts. So when I was managing money, I had more, families come in and say, gosh, my junior gold miner is down 64%. And we have to sell everything. And, so it's always, it's never been a great trade of mine. But over the last, since I've been running our Traders Elite room since 2001, I've really used gold a lot wiser and traded it a lot better, just simply going from a non-emotional sentiment bias. And sentiment got really, really poor at the end of the year, and we bought into the gold futures and into ETFs at right at the end of the year, stayed long. We got stopped out in that October pullback and then got back in again just recently, actually right around the 4th of July. And we've got targets at 1310 just short term here. So again, that 1310 area.
It stops. A lot of people will be calling it a breakout, and that's where you'll be going to the door.
Absolutely.
I guess a lot of people, if you want to look at the most bullish possibility, say that what happened in 15, the end of 15, was the beginning of this new move, and then we put in a higher low for 2, and we're either starting 3 or C, and we're getting a pullback in here, which would be this is a weekly, be our 3rd higher low, and we're going to break out over 1,300, and it could be a huge move. I know a lot of people that are talking 1,500 or so on the gold. I'm just trying to pull up, you know, they're a little longer term view on gold, and the dollar's peaked for the year. But even that, a rally back to 1,500 would just be a corrective move off this big decline. I'm sorry, I'm interviewing myself, but
no,
maybe it's A, B, A, B, C up to here. So wow, it's on a 50-month moving average right here.
Right, and it's a time where you can tell from the volumes also that people hate gold. They really do, and they hate to talk about it. I've got professional traders in the room that just you know, they get mad at me, get physically mad. I think at times, even when I bring up gold.
That's funny. You know, they have reasons though. I mean, you know, you look at all the paper out there, and you know, they are able to move the market with paper. In fact, you know, one of the original gold bugs, Jim Sinclair, that's why he started an exchange, I think in Shanghai, where it's cash and carry, and he talks about the emancipation of gold and silver from the paper market. So just like there's a plunge protection team, a lot of precious metal traders believe there's a team that does all they can to put a cap on gold, because Larry Williams used to say the price of gold going up is like a rising temperature for financial conditions, which, you know, if you get too much of a fever, it's not healthy when gold in the market and everything's going up together, because gold is more about, you know, I call copper the metal of construction and gold the metal of destruction, that destruction. So yeah, nice call there on the gold. So you're bullish everything.
Yeah, this is one of those times, and at least in the short period, that where just everything's going to go up. I mean, look at the bond market today. Look at gold. Look at stocks. Look at oil. I mean, it's one of those rare times when it's a Fed-induced global synchronized type rally, but it is, you know, it is late cycle, Dale, and we gotta understand that you know, this will end, but you know, I'm a short-term market timer.
Yeah, so I mean, you know, it ends 2 years from now. It's that's a lifetime to me.
Exactly. We cannot, you know, we have to trade what's in front of us, and right now, you know, up is in front of us, and you know, when you look at long term for somebody my age is you know, right into August, I think. But we go day by day as traders, and we learn a lot day by day. And the fact is that I don't think anybody would have ever thought that we would be, you know, sitting here after an election. I'm sure you remember election night with that.
Yeah, I do. Horrendous. I was surprised. I was surprised it came off limit down.
Yeah.
But I didn't know Icon left the celebration party to go buy $1 billion. So you know, he's on the plunge protection team too, I guess. But
exactly, and who would have thought with you know, we're going into our 7th month here, and there hasn't been anything accomplished towards the Trump agenda really, other than a lot of the executive orders, which are fine because they're leading people, you know, to one of the things that I didn't mention about fears. I don't know whether you pay any attention to it, but Dr. Zweig used to do a lot of work in balance sheets and things like that. He would create all kinds of signals and indicators. Just fascinating to watch and fascinating to study even today. But one of the things that has even new Treasury Secretary Mnuchin worried is the fact that tax receipts have dropped off so much. People just are not paying their taxes, and that's going to really hurt in the next 6 to 9 months when we go to negotiations on a debt ceiling and things like that. And that's one of those things that I didn't mention earlier, but the fact is people just aren't paying their tax. We've seen the biggest drop in tax receipts we've seen since the 70s, and that might be something. All of a sudden, people really truly believe that they don't have to pay taxes, and when that revenue doesn't come in, and when we're actually cutting taxes, where in the world is the money going to come from other than the printing press?
Right. What a great discussion, Tom. You want to tell the community that I'm sure are interested in the discussion. We're getting some nice comments here. How they could follow you. I know your Twitter handle is @TomandPrishna. And who's Prishna?
Prisha, that's my wife, my lovely wife.
Okay, Prisha. Okay.
42 years yet. Just follow me at Tom and Prisha on Twitter. That's the easiest way. I've got a link to my website, tttHedge.com there. And I don't post very much on the website, but Twitter has turned into such a great place for traders. Like I said, that's where I met you and your great group and all your followers, and I think it's a tremendous opportunity for individual investors to get really quality information. Again, you can sort out what you believe are people that know something about the market, and you can block people that don't know much about the market. So again, we get a little bit of both in that.
There's an expression: you don't know if somebody cares until you block them. Ever hear that one?
That is we are in the Twitter society now, aren't we?
I'm the king blocker, and then I unblock, and the whole thing. Anyway, Tom, I want to say that it was great that I invited you and you came and you had patience. We needed FX content on the original date, but I would love to talk to you again a little bit further down the line, maybe into the fall, and see what your thoughts are. And so you have a trading room, and there's a monthly subscription fee for that to be in your room?
Yeah, and we do it on a yearly basis. It's kind of weird the way that my room has progressed. We had several thousand back in the early 2000s, but I moved it into because just because I always say, out of all the things that we do, time is our biggest resource, and
right.
We have no idea whether we're going to, our next breath is going to come from here. So again, we cut it down to where I have owners, not members. I don't really have subscribers. I have a few subscribers just on email, but I want our traders that are in the room, and all the traders that are in my room are elite type based traders where they really know what they're doing, and they know the risks. They know that if I screw up, it's not because I want them to lose money. It's because I really had a good theme, a good idea, a good thesis. I've got facts to back it, and I'm taking a position with a trailing stop, and if it works out, everybody's better off. If it doesn't, you take your loss and you move on to next stage. So we're very simple. It's a lot of fun every day to wake up and have the opportunity to invest. I mean, there's a lot of places where you can't do that with, again, such a low cost of investing, and it doesn't take much entry to get in, and I can't think of a better place to be right now in 2017.
All right, partner. Well, you are now my trading warrior brother. And,
right.
I hope for the best for you and your trades and your community. And I know I really enjoy interacting with people, social trading. We only have 2 eyes, Tom, even if they're trained. Better to have 100 trained eyes collaborating. So I agree with you in your mission, and thank you so much for your time again today. Everyone, thank Tom Malone for a great discussion and a few ideas and a look down the road. Thanks for bringing your telescope today, Tom. And I'll drop the link of the interview on Twitter. I'll tweet it and drop it off to you. So have a great weekend, my trading warrior brother.
Thank you. And anytime, Dale, I really appreciate it, and best to all your traders out there.
Thank you, buddy. All right, Face, we went a little overtime, but I know you don't care. I think we had a decent week, and look forward to killing it with you guys again next week. Remember, most of all, don't just count your pips, count your blessings. And I hope you feel that this free room for you is a blessing, And if you want to reciprocate, become a subscriber. The link's right there. Have a great weekend, everyone. Enjoy your summer. And I'll see everyone on Monday. Thank you, Steve Volge. Thank you, Blake. Thank you, Greg Horvat, for coming in here and clearing up a few things. There should be some nice setup shorts and cable and euro next week. Adios. See you, Ronan.